remember my first job, sitting down in the conference room, and Linda, the HR lady, comes in. I sign the contract, I get my keys, and Linda slid a piece of paper in front of me and said, "Hey Scott, would you like to start saving for your retirement?" Now, at this point in my life, I was 22 years old, newly graduated, and broke. I had no money, so saving for anything sounded okay with me. I said, "Sure, Linda, what do you got?" She said, "Well, we've got a great benefit package here. We've got something called a 401k plan," and at that point in my life, I'd never heard of that. I said, "Linda, how does a 401k plan work?" She said, "Well, here's how it works." She said, "It's great. You get paid here twice a month. What we do is we take money out of every paycheck. You don't pay any tax on that money. We put it in an account for you, and you get to invest that money. And you do this pay period after pay period after pay period, and at the end, when you go to retire, you're gonna have a really big account that you can spend in your retirement." And I thought to myself, well, geez, that sounds great. I said to myself, "You know, Linda, that actually sounds like a really good plan, but I wanna make sure I understand exactly how it works. I heard you say I don't pay the taxes on that account. So when does the company pay the taxes on that account?" And Linda kind of looked at me shocked, and she could tell I was really new to the workforce. And she said, "Well, Scott, we don't pay the taxes. The company isn't going to pay them. You're going to pay it." And I thought about that for a second, and I said, "You know, Linda," I said, "I appreciate the offer on the 401 thing, but I think I'll pass." And I must have been the first person to ever tell her this. She said, "Well, why?" I said, "Because I don't think I want this big account later on in life that I have to pay a bunch of taxes on." And the next words out of her mouth went just like this. She said, "Scott, I get it. But don't worry about that. Because when you take the money out of that account, you'll be in a much lower tax bracket than you are today." Let me ask you a question. Are you in a lower tax bracket today than you were in your 20s? Than you were in your 30s? Than you were in your 40s? The answer is probably no. Everyone is telling you that the 401k, the IRA, the 403b if you're a teacher are the greatest accounts you can own throughout your retirement years. I'm telling you that the 401k, the traditional IRA, or any of these accounts you haven't paid taxes on yet are the absolute worst accounts you can own throughout your retirement years. Why? Because there's rules associated to these accounts, right? And who makes the rules? Do we make the rules? The IRS makes the rules. So I want to go back to the year 2017, 4 years ago. And I want to assume that we are married filing jointly, and let's say that we have $100,000 of income. Okay? So 2017, $100,000 of income, married filing jointly. Now, the beautiful thing of our tax code in this country is that we've got really big tax brackets. So 4 years ago, if you had an income of $100,000, your tax bracket started roughly around $72,000 and went all the way to about $153,000. So it didn't matter if you made $73,000 that year or you made $151,000 that year, you were in the same bracket. For every dollar that fell on this line 4 years ago, we owed the IRS a quarter, or 25%. Okay? So let me ask you a question. Would you rather pay taxes at rates you know or ones you don't? If you're like me, you'd rather pay at rates you know. Well, we know what the tax rates are this year. Did you get in writing from the IRS what the tax rate was going to be on your 72nd birthday? Or on your 75th birthday? The answer is probably no. And you think they're going to go up, and I think they're going to go up. So if we'd rather pay at rates we know, and we think taxes are going to go up, here's my next question. How much more income could you have made in 2017 and still been in the 25% tax bracket? That's right. About $53,000, the difference from here to here. So if I think taxes are going to go up and I'd rather pay at rates I know, why in the world would we ever let the IRS tell us when to start taking money out of our taxable retirement accounts? Why would we not take money out of those accounts today, pay tax on that money today, which you believe to be a lower tax rate, and I believe to be a lower tax rate. Get that money, pay some tax on it, and put it in a tax-free account. Now, what do I mean by tax-free? I mean it's a type of account where your money grows tax-free. You take it out tax-free. You pass it on tax-free. Doesn't that sound nice? There's only two accounts we can do that. One's called a Roth account, Roth IRA, Roth 401k. The other is permanent life insurance. So when you're thinking about paying taxes, we want to make sure that we're maximizing that bracket that we're in. But now I'm going to show you in 2018 where the rules changed for us a little bit. So President Trump signed something called the Trump Tax Plan into law in the year 2018. And it's scheduled to be there till the year 2025. Now, I think we all probably could agree, without getting political, that whatever President Trump did is probably going to get undone at some point. But when he signed this bill into law, two things changed for you and me. So let's assume the very next year in 2018, you made that same $100,000. The first change that happened were the bracket sizes changed. So this year, the bracket, if you made $100,000 and you're married filing jointly, your bracket basically goes from about $76,000 all the way to about $176,000. So the bracket sizes changed just a little bit. But the second thing that changed were the rates that we owe the IRS. So for every dollar that falls on this line, we don't owe the IRS a quarter any longer. We only owe the IRS 22 cents on the dollar, or 22%. Now you might be sitting there thinking to yourself, wow, 3%, big whoop. But I would bet that you would take a 3% return on a portion of your money, risk-free and fee-free, right now. It's more than the bank pays you. It's more than your money market pays you. It's even more than those certificates of disappointment pay you. So here's a question. Did you take advantage of these lower tax rates back in 2018 and move money from a taxable account to a tax-free account and pay lower taxes in 2018? Did you do it in 2019? Did you do it in 2020? Don't miss another year of this. This is a lot of money back into your retirement, potentially in tax savings. It's real easy when you visit with me and my team for us to help you with this. Here's all you have to do. Hey, Scott, here's how much I saved in those taxable accounts, and here's a copy of my last year's tax return. Can I take advantage of that thing you were talking about and potentially save and lower taxes? And we'll be able to tell you that. This is a huge, huge potential savings that puts money right back into your retirement, regardless if the stock market goes up, goes down, or goes sideways. Contact us today and let us help you with it. I look forward to seeing you in the next video.